On January 15th, 2015, something happened in the foreign exchange market that wasn't supposed to be possible. Thousands of traders around the world were holding what many believed was the safest trade in Forex. Not the riskiest, not the craziest, the safest. Some were using their life savings, some were using enormous leverage. Brokers encouraged it, analysts loved it, risk managers approved it. For years, the trade had worked exactly as expected. Month after month, year after year. Nothing happened, and that was exactly why people trusted it. Then at 10:30 in the morning, everything changed. Within minutes, billions of dollars vanished. Traders were wiped out. Some lost far more than they had invested. Brokers collapsed. Hedge funds disappeared. Businesses found themselves fighting for survival before they had even finished their morning coffee. Across Europe, families watched debts explode overnight. And the strangest part, almost nobody saw it coming. Not the traders, not the analysts, not the institutions. Not even many of the people whose job was to think about risk. Because this wasn't supposed to happen. The trade was considered safe. The system was considered stable. The risk was considered understood. But on that morning, one decision shattered all three. And the Swiss franc crash might be the most expensive example of that lesson ever recorded. Because the people who suffered most were not reckless gamblers. They were people who built their lives around a promise they believed could never be broken. And when that promise disappeared, so did everything built on top of it. The question is, how can the safest trade in Forex destroy everyone? To answer that, we need to go back, not a few weeks, not a few months, 4 years, because the Swiss franc crash didn't begin on January 15th, 2015. That was just the day everybody noticed it. The real story started years earlier, long before the bankruptcies, long before the panic, long before billions of dollars disappeared from trading accounts around the world. And that's what makes this story so fascinating. Most people think disasters are caused by chaos. They imagine wild volatility, extreme risk, reckless speculation. But that's not what happened here. The Swiss franc crash wasn't caused by volatility. It was caused by certainty. The people who got hurt weren't taking what they believed were dangerous risks. Quite the opposite. They believed the risk had already been removed. That's the trap. Because the most dangerous risks are rarely the ones people can see. The dangerous ones are the risks people stop looking for. The risks that slowly disappear from everyone's mind. The risks that become so familiar, so predictable, and so accepted that eventually nobody questions them anymore. And once that happens, something strange begins to occur. People start making bigger decisions, bigger bets, bigger commitments. Not because they become reckless, but because they become comfortable. A trader increases leverage, a hedge fund increases exposure, a business builds its pricing around a stable exchange rate, a family takes out a mortgage they believe is safe. Each decision makes perfect sense on its own. The problem is that all of those decisions are built on the same assumption. The assumption that tomorrow will look like yesterday. And for years, that assumption seemed correct, which is exactly why so many people believed it. The deeper you look into the Swiss franc crash, the more it stops looking like a currency story and starts looking like a story about human nature. About trust, about certainty, about what happens when intelligent people become so confident in a system that they stop imagining it can fail. Because by the time the crash arrived, the real damage had already been done. The positions had been built, the debts had been taken, the businesses had been structured, the promises had been believed. And the Swiss franc crash might be the most expensive example of that lesson ever recorded. To understand how the trap was built, we need to leave the trading screens for a moment and go back to Europe in 2011. At the time, fear was everywhere. Governments were struggling, banks were under pressure, investors were worried about what might happen next. And whenever people become afraid, they start looking for somewhere safe, a place they can trust, a place that feels stable when everything else feels uncertain. For millions of investors, that place was Switzerland. Switzerland had a reputation that most countries would envy. Politically stable, financially conservative, neutral, reliable. The kind of place people trusted almost instinctively. So every time fear spread through global markets, money rushed into Switzerland. And then more money arrived, and then even more. It became a pattern. Whenever the world got nervous, investors bought Swiss francs. Whenever the headlines became scary, investors bought Swiss francs. Whenever uncertainty increased, money flowed into Switzerland. At first, this seemed like a compliment. But eventually, it became a problem. Because the more money that entered Switzerland, the stronger the Swiss franc became. And the stronger it became, the more damage it caused to Swiss businesses. Imagine running a company that sells products overseas. Every month, your prices become more expensive compared to competitors. Not because your products changed, not because your workers changed, but because your currency keeps rising. The safer Switzerland looked to investors, back. The more painful life became for Swiss exporters. The country was being punished for being trusted. So the Swiss National Bank, the country's central bank, decided to step in. Their message was simple. The Swiss franc would not be allowed to rise beyond a certain point against the euro. There would be a floor, a line in the sand, 1.20. No matter what happened, the bank would defend it. If necessary, they would create money, buy foreign currencies, do whatever it took. The message wasn't subtle, it was a promise, and the world believed it. Because when an ordinary person makes a promise, people might doubt them. When a central bank makes a promise, people listen, especially when that promise keeps working. And that's exactly what happened. The floor held, then it held again, then it held again, month after month, year after year. The promise survived every test. Around this time, a man named Thomas Jordan found himself at the center of the system. Jordan wasn't some reckless gambler. He wasn't a celebrity economist making outrageous predictions. He was a careful central banker, methodical, reserved, the type of person trusted with protecting a nation's financial stability. When he became chairman of the Swiss National Bank, he inherited something extraordinarily powerful. Not just a policy, not just an exchange rate floor. He inherited the trust of the entire market, and that trust kept growing. Because every day the floor survived, the promise became stronger. The stronger the promise became, the less people questioned it. And that's where the psychology started to change. At first, investors treated the 120 floor as a policy. Eventually, they treated it as a fact. Then they treated it as a law of nature. The difference is enormous. Policies can change, facts can be challenged. But laws of nature feel permanent. People no longer asked whether the floor would hold. They asked how much money they could make because it would hold. Think about that for a second. If one of the most powerful financial institutions in the world is publicly guaranteeing a price, if that guarantee has survived for years, if every previous test has failed to break it, then what conclusion would most people reach? The same conclusion traders reached. The same conclusion hedge funds reached. The same conclusion brokers reached. The same conclusion analysts reached. If a central bank guarantees the price, isn't that free money? And that is where everything changed, because the moment people stop seeing risk, they start building their lives around its absence. And this is where the safe trade was born. And at first it looked brilliant. The logic seemed almost impossible to argue with. The Swiss National Bank had drawn a line in the sand. 1.20. They had publicly committed to defending it. And every day that passed seemed to prove they meant it. The floor held. Then it held again. And again. Months passed. Nothing happened. The floor held. A year passed. Nothing happened. The floor held. Another year passed. Still nothing. The floor held. By now, something subtle was happening inside people's minds. The trade wasn't becoming safer. It was becoming familiar. And familiarity is dangerous. Because the human brain has a habit of turning repeated outcomes into expectations, then turning expectations into beliefs, then turning beliefs into facts. Eventually, people stopped asking whether the floor would survive. The floor had survived. That question felt settled. Instead, they started asking a different question. How much money can I make? And once that question takes over, everything changes. Retail traders started piling in, then professional traders, then hedge funds, then institutions managing billions of dollars. The trade spread through the financial world like a rumor everyone wanted to believe. Because unlike most opportunities, this one appeared to offer something extremely rare. Reward without fear, profit without uncertainty, risk without consequences. Of course, none of those things actually exist. But for a while, it felt like they did. And that feeling became addictive. Brokers loved the trade. The more clients participated, the more trading volume they generated. Analysts loved the trade. The data seemed to support it. Risk managers approved it. Historical volatility kept falling. Every model pointed in the same direction. Everything appeared stable. And stability has a strange effect on human behavior. It doesn't make people cautious, it makes them confident, then overconfident, then blind. As confidence grew, leverage grew with it. Why risk your own money when you can borrow more? Why settle for modest returns when the downside appears limited? Why control $10,000 when you can control $100,000, or $1 million, or $10 million? After all, the floor was there. The guarantee was there. The Swiss National Bank was there. The logic seemed airtight. And that's exactly why the trap became so large. The safest-looking opportunities often attract the biggest positions. Not because people are reckless, because they believe they're being responsible. One of the most revealing examples came just days before everything collapsed. Between January 9th and January 14th, 2015, economists from major financial institutions were surveyed about the future of the Swiss franc. 22 economists, 22 professionals whose job was to understand markets. Not one expected the floor to disappear that year. Not one. Think about what that means. This wasn't a situation where everyone saw danger approaching and ignored it. The danger wasn't visible. The possibility barely existed in people's minds. The consensus was nearly absolute. The Swiss National Bank would defend the floor. The floor would survive. The system would continue. Tomorrow would look like yesterday. And that's the deeper lesson hiding underneath this story. Humans are remarkably good at adapting to stability. But we are terrible at remembering that stability can be temporary. A calm day feels normal. A calm year feels reliable. A calm decade feels permanent. The longer something survives, the harder it becomes to imagine it ending. People stopped seeing the floor as a policy. Policies can change. Policies can fail. Policies can be reversed. Instead, they started seeing it as reality. Reality doesn't change. Reality simply exists. And once enough people believe that, the trap is complete. Because by the end of 2014, billions of dollars, thousands of careers, entire businesses, and countless personal financial decisions were built on a single assumption: the floor would always be there. But behind the scenes, the people defending the floor were beginning to panic. Because while traders were becoming more confident, the world was changing. And every change made the Swiss National Bank's promise harder to keep. At the center of it all was Thomas Jordan, the same careful central banker who had inherited the system, the same man millions of investors trusted, the same man standing behind the promise that the floor would hold. Publicly, everything looked calm. Privately, the situation was becoming far more dangerous. The problem wasn't Switzerland. The problem was Europe. By late 2014, the European economy was struggling. Growth was weak, inflation was disappearing, and the European Central Bank was preparing something enormous: a massive money printing program known as quantitative easing. The goal was simple: flood the financial system with money, push down interest rates, stimulate growth. But there was a side effect. The euro was becoming weaker, and that created a nightmare for Thomas Jordan. Because the Swiss franc wasn't floating freely, it was tied to the euro. Every time investors lost confidence in Europe, money fled toward Switzerland. Every time fear increased, more money arrived. Every time the euro weakened, pressure on the floor increased. The promise that had once looked strong was becoming harder and harder to defend. Imagine trying to hold back a river with a wall. At first, the wall barely notices the water. Then the river grows. Then it doubles. Then it triples. Eventually, the question is no longer whether the wall is strong. The question is whether the pressure ever stops. And the pressure wasn't stopping. It was accelerating. To defend the floor, the Swiss National Bank had to keep buying euros. More and more euros. Every wave of fear required another intervention. Every intervention made the bank's balance sheet larger. Every month the commitment grew. The promise was no longer costing millions. It was costing tens of billions. Then hundreds of billions. The Swiss National Bank was becoming one of the largest holders of foreign assets on the planet. And with every purchase, the risk increased. This is where most people misunderstand the story. The market wasn't trapped. Not yet. The traders weren't trapped. Not yet. Thomas Jordan was trapped. The Swiss National Bank was trapped. If they kept the floor, they could be forced into buying endless amounts of a weakening currency. Their balance sheet could continue expanding to dangerous levels. The risks could become impossible to control. But if they removed the floor, they would destroy the very certainty the market had built itself around. Neither option was good. One threatened the future of the central bank, the other threatened the future of everyone depending on the promise. And every day, the choice became harder. What's remarkable is that almost nobody outside the bank understood how serious the situation had become. The market still believed the floor was untouchable. Analysts still believed the floor would survive. Traders still believed the floor would survive. Even professional economists believed the floor would survive. Meanwhile, the people responsible for defending it were staring at a completely different reality. A reality where the costs kept rising, the pressure kept building, and the exits kept disappearing. Then came one of the most important moments in the entire story. Just weeks before the crash, Thomas Jordan publicly reassured the world. The floor remained the cornerstone of Swiss monetary policy. The commitment remained in place. Nothing was changing. For investors, it was exactly what they wanted to hear. For traders, it reinforced everything they already believed. For anyone holding the safe trade, it felt like confirmation. The guarantee still stood. The floor still existed. The system still worked. Looking back, that's what makes this moment so chilling, because the reassurance wasn't followed by another year of stability, or another month, or even another week. 3 days later, everything changed. On the morning of January 15th, 2015, the trap finally snapped. 10:30 a.m. Zurich. Without warning, without leaks, without preparation. The Swiss National Bank released a short statement. The 1.20 floor was gone. Just like that. 3 years of certainty disappeared in a single sentence. For a moment, nobody understood what they were looking at. Traders stared at their screens. Fund managers refreshed terminals. Brokers scrambled to verify the news. Surely there had to be a mistake. The floor wasn't supposed to disappear. It was the floor. The entire trade existed because everyone believed it couldn't disappear. But it had. And within seconds, panic began spreading through the financial system. At first, the market tried to react normally. Orders flooded in. Traders rushed to exit positions. Funds tried to reduce exposure. Risk managers tried to calculate losses. But then something far worse happened. The market itself began to disappear. The banks that normally provided prices started pulling their quotes. Algorithms that usually supplied liquidity switched themselves off. Market makers stepped back, one after another, then another, then another. Suddenly, there were thousands of people trying to sell, and almost nobody willing to buy. This is the part most people misunderstand. The Swiss franc crash wasn't caused by volatility. It wasn't caused by prices moving too fast. It was caused by something much more dangerous. Liquidity vanished. The market didn't crash because prices moved. The market crashed because prices stopped existing. Imagine a crowded theater with one tiny exit. Everyone rushes for the door at the same time. The problem isn't movement. The problem is there isn't enough space for everyone to get out. That was happening inside the foreign exchange market. Millions of dollars were trying to escape, but there were no buyers waiting on the other side. And when buyers disappear, prices don't move smoothly. They jump, they gap, they teleport. Entire sections of the market simply vanish. Which brings us to one of the most painful stories of Black Thursday. A retail trader was holding a £5,000 account. Nothing extraordinary, just an ordinary trader, like thousands of others. But there was one detail. He was using 400-to-1 leverage. On paper, it felt safe. The Swiss National Bank had defended the floor for years. The market barely moved. Risk seemed almost invisible. So with £5,000, he controlled roughly £2 million worth of currency. And just like everyone else, he had protection. A stop loss. Or at least he thought he did. Because most traders imagine a stop loss as an emergency brake, a shield, a safety net, something that guarantees an exit. But that isn't what a stop loss really is. A stop loss is simply a request for somebody else to take the trade. And on Black Thursday, nobody was there. The stop triggered, but there was no buyer. The market kept falling. The order kept searching, lower, 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 trying to find anyone willing to take the other side. When it finally found one, the damage was catastrophic. By lunchtime, the trader's £5,000 account was gone, not reduced. Gone, and worse than that, he now owed approximately £100,000, a debt 20 times larger than his original investment, in a single morning. The same thing was happening everywhere, across retail platforms, across hedge funds, across banks, across entire countries. Then came one of the most controversial stories of the entire crash. A trader known publicly only as Mr. S. Immediately after the chaos began, he received confirmation from his broker. His positions had closed. He was profitable, around £41,000 in profit. Against all odds, he appeared to have survived. Imagine that feeling. The relief, the disbelief, the sense that you had somehow escaped the disaster. Then hours later, everything changed. The broker informed him that the trade would be repriced. The original execution was being canceled. The market had been too chaotic. The price wasn't valid. A different execution price would be used. When the recalculation was finished, his profit had become a debt. Not a small debt, not a painful loss. A debt of £739,040. One morning he thought he had made money. That same evening he owed nearly £750,000. Whether people believed the broker was justified or not almost didn't matter. The emotional damage was done. The event shattered one of the deepest assumptions investors have, that when a trade closes, it is closed. That morning taught the market something terrifying. Even certainty itself could be repriced. Meanwhile, the brokers were fighting for survival, because the traders weren't the only victims. Every negative balance on every client account was becoming someone else's problem, and that someone was often the broker. One of the biggest retail brokers in the world was FXCM. For years, the company had reassured customers. Trade with confidence, trade with leverage, trade with protection. Then Black Thursday arrived, and thousands of client accounts exploded simultaneously. The losses were so large that clients couldn't pay them back. FXCM was suddenly staring at a hole worth roughly $225 million. In a matter of hours, one of the largest retail brokers on earth was fighting for its life. The company survived only because an emergency rescue deal arrived before regulators could shut it down. Others weren't so lucky. Some brokers disappeared entirely. Some entered insolvency. Some never reopened. Years of business destroyed before the trading day was even over. And through all of it, human traders were desperately trying to understand what was happening. Not because the market was moving, but because the market had stopped functioning. Prices were flashing everywhere. Quotes were disappearing. Spreads were exploding. Algorithms had retreated. The machines that were supposed to make markets efficient had vanished the moment they were needed most. For nearly an hour, one of the largest financial markets on Earth was struggling to discover a price. And when it was finally over, when the panic slowed, when liquidity returned, when the charts stopped looking like heart monitors, the lesson became impossible to ignore. The crash was not caused by volatility, it was caused by the disappearance of liquidity. And a stop loss was never protection. It was merely a request. The disaster was over, but the damage was only beginning. The market eventually stabilized. The headlines stopped, the charts calmed down, the panic faded. But for thousands of people around the world, Black Thursday was just beginning. Because market crashes don't stay inside markets. Eventually, they leave the trading screens and enter real life. They enter businesses, families, mortgages, jobs, entire communities. And nowhere was that more obvious than in a small Swiss factory. On the morning of January 15th, the owner of a Swiss manufacturing company sat down at work like he had on thousands of mornings before. He poured himself a cup of coffee. His business was healthy, profitable, stable. The company manufactured high-precision components used in industries like aerospace, Formula One, and medical technology. Years of work had gone into building it. Years of solving problems, winning customers, hiring staff, growing carefully. The company employed around 100 people. Families depended on those paychecks. Everything looked normal. Then he poured a second cup of coffee, and everything changed. A news alert appeared. The Swiss National Bank had abandoned the peg. At first it sounded like financial news, something for traders, something happening somewhere else. Then the numbers started moving, and he realized this wasn't a trader's problem. It was his problem. 75% of his sales were made in euros, but his employees were paid in Swiss francs. Overnight, the franc had become dramatically more expensive. His revenue collapsed, his costs didn't. The math was brutal. A profit margin he had spent years fighting to achieve flipped into a loss almost instantly. Not because he had made bad products, not because demand disappeared, not because management failed. Nothing inside the business had changed, yet suddenly the entire business model no longer worked. Years of effort had been destroyed by a decision made hundreds of miles away. Later, he described the experience in the simplest possible way. During his first cup of coffee, he was building a company. By his second cup, he was planning how to dismantle one. And the worst part? He wasn't thinking about spreadsheets. He was thinking about people. 100 employees, 100 families, 100 futures suddenly hanging in the balance. It was a perfect example of something nobody had understood during the years of stability. Artificial stability creates hidden fragility. The peg had made everything feel safe. But underneath that safety, vulnerabilities had been quietly accumulating for years. And now, they were all being exposed at once. But the damage didn't stop in Switzerland. Thousands of miles away, people who had never placed a trade in their lives were waking up to the same nightmare. One of them was a Romanian woman named Roxana Andriciuc. Years earlier, she had done what millions of responsible adults do. She bought a home. The mortgage was denominated in Swiss francs. At the time, that seemed sensible. Banks promoted these loans as stable. Interest rates were lower. Monthly payments looked manageable. The Swiss franc was viewed as one of the safest currencies in the world. Safe. That word again. Then Black Thursday arrived. Roxana's income didn't change. Her house didn't change. Her job didn't change. But her debt did. Almost overnight, her monthly payments surged. Families that had carefully planned their finances suddenly found themselves trapped. Some discovered they owed more than their homes were worth. Others watched years of savings disappear into rising loan payments. The crisis became so severe that borrowers began fighting back through the courts. Not for months, for years. In some countries, for more than a decade. Because the Swiss franc crash wasn't just a market event. It became a social event, a legal event, a political event. Nowhere was that clearer than in Poland. Hundreds of thousands of households had taken out Swiss franc mortgages. Many had been encouraged to do so because the loans appeared safer and cheaper than local alternatives. Then the franc exploded higher. Monthly payments surged. Debt burdens grew. Families found themselves trapped between rising obligations and stagnant incomes. Some spent years battling banks in court. Some won, some lost. But all of them paid a price. And while ordinary families struggled to survive, the financial industry was trying to survive too. FXCM, one of the largest retail brokers in the world, avoided collapse only through an emergency rescue deal. But it came at a cost. The company survived, yet control of its future largely passed into someone else's hands. It was less a rescue than a surrender. Alpari wasn't as fortunate. The broker collapsed. Its business effectively destroyed by the wave of negative client balances created during the liquidity vacuum. Elsewhere, hedge funds that had spent years convincing investors they understood risk were being wiped out. One of the most famous casualties was Everest Capital, an $830 million flagship fund. Gone. A veteran manager who had survived multiple financial crises was defeated in a single morning. Not because he misunderstood markets, because he trusted certainty. The same certainty everyone else trusted. And then there was the institution at the center of the entire story. The Swiss National Bank, the organization that had created the floor and ultimately destroyed it. When the franc surged, the massive pile of foreign assets accumulated during years of defending the peg suddenly lost enormous value. The losses were staggering, tens of billions vanished. But focusing on the number misses the real story. Because from Thomas Jordan's perspective, that loss wasn't the disaster. It was the escape cost. The price of getting out of a trap that had become impossible to maintain. For years, the SNB had been buying euros to defend certainty. Every intervention made the balance sheet larger. Every success made the eventual exit harder. By January 2015, there was no painless solution left. Keep the peg, risk destroying the central bank. Remove the peg, risk destroying the market. Either way, somebody was going to suffer. So the SNB chose the option that would hurt immediately rather than indefinitely. And the consequences spread across traders, brokers, businesses, homeowners, banks, and governments. Which brings us to the uncomfortable truth at the center of this entire story. Nobody escaped untouched. Not the traders, not the brokers, not the hedge funds, not the homeowners, not the exporters, not even the central bank itself. Everyone paid for the same mistake. They confused stability with safety. And then they confused safety with certainty. So, how did the safest trade in Forex destroy everyone? The answer is surprisingly simple. It didn't destroy people because it was risky. It destroyed people because it stopped looking risky. For years, the floor held. Every prediction seemed right. Every model seemed accurate. Every reassurance seemed justified. The trade kept working. And because it kept working, people slowly stopped asking questions. Traders stopped asking what would happen if the floor disappeared. Brokers stopped asking. Economists stopped asking. Fund managers stopped asking. Homeowners stopped asking. Even the people defending the floor convinced themselves they could keep defending it. The market wasn't hiding the risk. The risk was sitting in plain sight. People simply stopped looking for it. That's what makes the Swiss franc crash so fascinating. Because this isn't really a story about currencies or central banks or trading or even finance. At its core, it's a story about certainty. The moment something works long enough, it stops feeling temporary. The moment it stops feeling temporary, it starts feeling permanent. And the moment it starts feeling permanent, people begin building their lives around it. That's exactly what happened here. Traders built positions around it. Brokers built businesses around it. Hedge funds built strategies around it. Exporters built cost structures around it. Families built mortgages around it. Entire industries built plans around it, not because they were reckless, not because they were greedy, not because they were stupid, but because certainty is incredibly persuasive. Human beings crave stability. We want to believe the future will look like the recent past. We want to believe the systems around us will continue working tomorrow because they worked yesterday. And most of the time, that's true. Until it isn't. The people who suffered most during the Swiss franc crash weren't gamblers. They weren't thrill seekers. They weren't trying to get rich overnight. Many of them were responsible people making decisions that seemed perfectly reasonable. They trusted a promise made by markets, a promise made by institutions, a promise reinforced by years of experience. Then one morning that promise disappeared, and with it disappeared businesses, savings, careers, homes, fortunes, years of planning, years of certainty. The deeper lesson isn't that central banks can't be trusted, or that leverage is evil, or that markets are dangerous. The deeper lesson is that every system looks strongest right before people stop imagining its failure, and that's when risk becomes most dangerous, not when everyone sees it, when nobody does. On January 15th, 2015, the Swiss National Bank removed a line from a chart. What disappeared with it was something far more valuable: certainty.